All right, so let's get into the latest memo from the legendary investor Howard Marks of Oak Tree Capital. Now, if you follow the markets, you know he's one of the most respected voices out there. Seriously, when he talks, Wall Street listens. And today, we're going to break down his latest take on the market, which is, well, it's pretty sobering.
And this really gets to the heart of the puzzle, doesn't it? We're seeing the stock market hitting all-time highs, champagne corks are popping, but behind the scenes, one of the smartest guys in the room is sounding the alarm. So what is he seeing that maybe the rest of us are missing? Let's unpack the calculus behind his caution.
You gotta love it. He doesn't beat around the bush. Right up front, Marks just lays it all out there. He says, right now, it's time to play defense. This isn't some vague feeling or a maybe you should think about it kind of thing. Nope. It is a direct, tactical call to action. Start moving away from risk. So what on earth led him to such a bold conclusion?
Well, his argument kicks off with the cold, hard numbers. This isn't about gut feelings or sentiment. It's about looking at the objective data and what that data has told us time and time again about what's likely to happen next.
Okay, so check this out. At the beginning of the year, the S&P 500's forward price-to-earnings ratio, that's a key valuation metric, hit 23. So what does that mean in plain English? It means investors were willing to pay $23 for every single dollar of expected future profits. That is a sign of some serious optimism, and it's a number that's way, way above the historical average. So what usually happens when things get this pricey?
Well, history gives us a pretty stark warning about what that 23x number implies. Looking back, whenever investors have paid this much for stocks, their average annual return over the next decade has been somewhere between plus 2% and minus 2%. Just think about that. You're basically looking at a lost decade for your money.
And this year has been a perfect little case study in just how weird the market psychology is. I mean, look at this. In the first quarter, the market drops. Then, bam, we get hit with news of unexpectedly high tariffs, and it drops even more, down 15%. And that makes perfect sense, right? Bad news, stock prices go down. But then, something strange happened. Even though the fundamental picture was getting worse, the market completely reversed and just rocketed up 29% from that low. It's this total disconnect that's at the core of what's worrying Marks.
And this brings us right to the central battle that Marks sees playing out. It's this epic tug-of-war between worsening economic fundamentals on one side and just relentless, unstoppable optimism on the other.
It's like the market is telling two completely different stories at the same time. On one side, you have this huge wall of very real worries. The ripple effects of tariffs, inflation that just won't quit, signs of slowing growth, not to mention the massive U.S. deficit. But pushing against all that is this powerful wave of pure psychology. You've got FOMO, the fear of missing out. You've got the massive world-changing excitement around AI, and just this general feeling that, things will work out. And right now, as you can see, optimism is definitely winning.
And look, this isn't just about one or two metrics. Marks points to a whole dashboard of signals that are all flashing bright red. The price-to-sales ratio, a record high. Barclays has this thing called the Equity Euphoria Index, and yep, it's in bubble territory. The Buffett indicator, also at a record high. You're even seeing a return of craziness like meme stocks. And credit spreads are super tight, which means investors aren't demanding much compensation for taking on risk. It all points to the exact same thing. People are embracing risk like there's no tomorrow.
Now, to be fair, and Howard Marks is always incredibly fair in his analysis, he takes the time to seriously consider the other side of the argument. Maybe there's a good reason for all this. Why might these incredibly high valuations actually be justified? What exactly is the bull case here?
And it all comes down to those four famous and often dangerous words, this time is different. The sophisticated argument is that the big companies leading the market today are just built different. The theory is that they grow faster, they're less vulnerable to the ups and downs of the economy, they don't need as much cash to operate, and they have these huge competitive advantages, these moats that protect them. So, the thinking goes, they simply deserve to be valued more highly than the big companies of the past.
And here's where Marks' wisdom really shines. He doesn't just dismiss this idea. He actually acknowledges that for a select few, truly exceptional companies, this might actually be true. But, and this is the huge but, he warns that the classic mistake people make in a bull market is taking a solid idea that applies to a handful of superstars and then applying it to hundreds of other companies that absolutely do not deserve it.
So, what do we have? We've got a market with sky-high valuations, a bunch of worrying fundamentals, but also these really powerful, optimistic stories pushing everything higher. Given this incredibly risky environment, what does Howard Marks think we should actually do about it? Let's get into his very clear, very actionable playbook.
He introduces this brilliant analogy he calls InvestCon. It's directly modeled after the military's DEFCON system. their defense readiness condition levels. It's just a super simple, super intuitive way to think about how you should ramp up your defensive strategy as the market gets more and more dangerous.
So here's how this ladder of action works. It starts out pretty gently, at level 6, which is simply stop buying new stuff. As the danger level rises to 5, you start to trim your more aggressive investments. By level 4, you sell the rest of them. And in the most extreme, dangerous scenarios, you could go all the way to level 2, which is moving entirely to cash, or even level 1, which means you're actively betting against the market. It's just a crystal clear playbook for how to play defense.
Okay, so that's the framework. But here's the million-dollar question, right? After all this analysis, after looking at all the data, where does Howard Marks think we are on that Investicon ladder right now? What's the prescription for today?
And his answer is incredibly specific. InvestCon 5. This means it's time to actively reduce your aggressive holdings and start adding defensive ones. Now, notice, he's not saying sell everything and run for the hills. He's not at InvestCon 2. He's saying the balance of risk and reward has clearly shifted, and because of that, your portfolio should shift too.
So what does going defensive actually look like in practice? Well, for one, it means moving money out of stocks that look really expensive compared to history and into safer assets. And he specifically highlights credit investments, things like bonds. Now, while the extra yield you get for taking risk might be small, the absolute interest rates you can lock in right now are pretty attractive. In fact, they're competitive with the historical returns you'd get from stocks, but with the huge bonus of a contractual promise to get paid back.
And that really leaves us with the final and maybe the most important question. And it's one we all have to ask ourselves. It's pretty easy to sit here, listen to this logic, to nod your head and agree that a defensive strategy makes sense. But in a market that is absolutely driven by a powerful fear of missing out, do you have the discipline to actually do it? That right there is the real challenge.